Greetings, traders. Happy Tuesday. Samantha LeDuc, founder of LeDucTrading.com and CIO of LeDuc Capital LLC. I'm very happy that you joined me today. We've got Macro to Micro Power Hour and interviewing Jonathan Gibbons of VigTech.io, where I also have my risk indicators launching. And right now in a pretty intense beta test, very excited that they're going to be launched and made available globally on the App Store very soon for Apple. On this typical Tuesday every week, Jonathan joins me and we do an in-depth kind of macro to micro look at the markets. And today the focus is on bonds, all thing bonds. So let's promote Mr. Gibbons in his, there we go, in his home office, I think, down in Florida, although it looks like at the top of the world. I love this look.
This is ode to Elon and SpaceX, right?
Absolutely, in celebration of basically euphoric markets too, right? We've got some continued craziness in grinding higher markets into that 4,000 SPX level as VIX looks like it wants to make a gap fill down to that 1821, which was the pre-COVID launch pad for VIX. I am like psychologically excited for that level because I want to see it basically bounce. I'm assuming that this psychological level for 4,000 and also the gap fill in VIX will provide a little bit of support for traction, basically create a little bit two-way market again. We haven't had one for a little while.
Yeah, there's been no, there's one-sided transactions.
And bonds also one-sided on the down low. So this is kind of timely. We've got FOMC minutes tomorrow. Powell speaks at 2:30. We've got Bank of England on Thursday. We've got Bank of Japan on Friday. Basically, what, 10 banks? No, I don't know how many. Central banks in the next week will be rendering decisions on interest rates. And we did have Australia 2 weeks ago do a little yield curve control, while Japan lightened up a little bit. They said they were going to let it kind of swagger a bit. But I'm interested in your thoughts about, you know, what the Fed might or might not do tomorrow. I have mine, but how about you share yours first?
I don't know. My expectation at this point is to that they'll do nothing new, right?
Yep, I'm in agreement.
They will surprise with nothing. They've done nothing but be accommodative and talk to that stance for quite some time, and there's no real reason for them to change that right now. I mean, I know bonds have had a pretty bludgeoning period here, the long bonds have, but and rates have been rising, but I don't think that they're concerned at all. And I think that we had been looking at, I had mentioned, what was it, the last probably 3 or 4 weeks when I said, you know, from March, from the end of OPEX, from February through March, would be this period where you get some definitive kind of action, would be up or down. We saw equities continue to move higher, and there's no flows, bifurcation at all. These are all, you know, steady with the Dow and steady with the rotation trade that you've been talking about. They're all supportive on our infrastructure where we're reading the actual money flow, volume flow, stuff like that. And so the bond, I don't expect anything from them tomorrow. So, you know, going forward, and then you've got the stimulus hitting the tape this past weekend that we were talking about, the fiscal stimulus, where it's hitting people's bank accounts. You know, people are getting out and about. I just think they're in a wait and see mode to see what they think they're going to need to do in the late spring, early part of the summer. I think that is where my expectations are, that you'll see them have to react to something, which I think really leans towards inflation at this point, and them being a little trapped. So I don't expect anything tomorrow from them. Powell has done absolutely nothing. And I don't know that the reaction that we will get will be kind of an announced reaction versus they're going to have to react. I suspect that they have to react from some of these unintended consequences that we've been talking about. So you know, volatility, I got, you know, the term structure right now is just perfectly, you know, bottom left, top right, and you know, across the board, and you're seeing no reverberation. So it's continued rotation market. You know, I'm interested to see if NASDAQ makes it back up there again, right? Like that. I mean, you could really see a tear. I know that, the ARC complex and those types of trades are not, I don't know that those look like they can get back to new highs, but the Qs look pretty strong earlier today, and we'll see. So I wonder, they're in a position where they maybe see a sit and wait. Like I think that they want to see what they got to do as inflation starts to roar. And they keep saying there is no inflation and stuff like that. We all know there's inflation. It's just what is that reaction going to be? So that's my 2 cents at the moment. I don't expect a whole lot from them tomorrow. I'd say more the same. And with volatility being their number one enemy, which is totally their number one enemy. If they get if volatility is in the marketplace, then that causes displacements. The displacements cause them to react with liquidity, and when they funnel it with liquidity, then they're trying to curb the volatility concerns. So with no volatility, they feel pretty strong typically when there's limited volatility, and volatility being beat down. You could see something reflexive in volatility where it's just a reaction, but it needs to base build, see some sort of behavioral change. We're not seeing that in the options tape either. It's a rotation to, you saw some of the Momo stuff up 25% to 15%, 10% yesterday.
Bounces though, strong bounces.
Yeah. These are rotation, right? But they're trading environment. So I think that's in a nutshell, that's where my stance is right now. It's like we're here at the end of the March period for options expiration. I think that now we're into, the Biden's first 100 days. He did the stuff. We got the $1,400 checks. Then we're getting the infrastructure stuff coming in. Now we see what the inflation, what is this really gonna entail? And I mean, I think it's really interesting, and I think you got to consider as a trader or an investor that at any point in time in the last 12 months that it was not sensible or rational. It's like from a reversion standpoint. So this should be, it should revert, or this should mean react to something like this, right? And so far it's just readjusted, right? And readjusted. And they, hey, this thing's getting warm, they should take the foot off the gas, and we throw fiscal with monetary, right? So it would seem like the expectation they should take is that unless something forces them to do something different, then theoretically you can expect more of the same, if not them to continue to do it. And I was talking to somebody this weekend, just kind of, and it was really, it's like my buddy that runs a shorts desk. And, and I'd said this about a month, 2 maybe ago. And, it's like, how are the short, how the big short traders feeling right now? He's like, no, they're still not taking shorts.
Yep.
Even though, you did see some of the ARC reprieve and some of those momentum trades get hit a little bit, big whale traders still very nervous to take any shorts. And so I think that, until you see some sort of behavioral change in the market structure, and the positional change in the market structure, this can continue to be your, very, very, very well done call for rotation, right? If there's no volatility, then it just rotates from sector to sector. If there is volatility, then everything gets hit, and the Fed reacts. We don't have any volatility right now, so I expect them to do nothing.
Okay. Well, I have this term I've used the past few interviews, which I think has been really the past 2.5 weeks. I call it, maybe more, the fragility of chop. So we had a great deal of this chop into tech sell-off as the bond proxy, as bonds really fell hard, and surprisingly with absolutely no bounce. And then we also had the grind higher in the indices while tech is trying to recover, but not impressively so. It was definitely the rotation into energy, oil and gas, oil as an inflation hedge. So this fragility of chop, I still see in play, especially now with liquidity kind of soft going into FOMC tomorrow. This is a big deal. They're waiting to hear if there's anything regarding, dovish, hawkish interpretations. But besides my thesis of fragility of chop, and that's across everything, even energy right now, because after 7 weeks of running hot, we have 3 days of a pullback in oil. So it's kind of retesting the resolve of the bulls. And I think that's okay. I mean, we got as high as 68 in crude, and we can go all the way down to 60 and still be bullish as a potential trend reversal higher. So, as far as digesting this month, because we had such outsized gains. So for me, indices are digesting. This is what I, wrote to clients. Neither buyers nor sellers are stepping up in front of FOMC. Lots of continued moves in value plays, especially the reopening themes. And I've been on that. Airlines, cruise lines, travel sites, select retail department stores, strongly moving higher. And then even despite the print this morning in retail soft, it's still been a phenomenal play. And I think they're going to surprise for Q1 results as well. So I still think it has durability. The energy, oil, and gas plays, yes, they did phenomenally well, and now they're coming back in. But this is because it has been a trend for months, and then it gets exceedingly hot, and then it needs to cool. That doesn't mean it's going to reverse. There's a period of chop, and that's normal. So I think right now, crude oil has been consolidating basically after bottoming on November 2nd, which was that Georgia blue wave. I'm talking about crude oil right now is consolidating after a outsized run. But the rate of change in the yields, not obviously the shorter duration ones, but the 5-year hot fire flames, unprecedented rate of change, the 10-year, the 20-year, this is not something, and that's like 6 consecutive weeks. We might be calming down again into all these central bank announcements this week. But long story short, when I look at the rate of change and the unprecedented strength in this move, this tells me folks aren't really prepared for how strong this is. And the fact that the Fed had the Fed heads had the power to talk it down several occasions before their blackout period, from Bernard to Bullard to Powell, and they didn't. But then I saw something today, and it kind of got my interest piqued. You and I have talked about how the dollar has been bottoming for about 14 weeks. It's now moving a little bit higher. We are expecting that, right? I have a $95 price target on the dollar, even if crude takes off into outer space. Great backdrop, by the way. So I'm still bullish the dollar. I'm still, for right now, until proven, guilty, I still see higher oil and commodities. We can see the rotation into platinum, palladium, uranium yesterday, taking the place of oil. I don't know if you've seen these moves, but they have been stunningly strong in other commodities while energy catches its breath. So I'm still in the inflation, camp, that expectations are going to drive higher CPI. Gas is going to continue higher, faster than oil. We're going to have commodities and things over paper be a theme for 2021. I'm not done with that yet. So, going into tomorrow, the data point that I saw today was getting me a few data points that got me, in preparation for this interview, got me kind of interested. First, I noticed, I already have a theme about inflation for a while, right? But the dollar yen, and that pair trade, that carry trade, but in particular, how weak the yen has been. And let me just show you, I think it's probably easier to explain. Let me just, first of all, share a screen real quick. Okay, I think it matters. I'm going to get to a point. Okay, so take a look. This is a TLT, just, for retail purposes. I can make it really clear, but see this January 27th? Let me know if you can see my.
Yep.
Okay,
Yeah,
right here. Okay, January 27th. And then you can see what happened with bonds, right? We had a little bounce here, but here we are. This happens to be monthly support of 136. But from peak to trough, which happens to be, August, to where we are, it's a solid 20% pull down, right, in bonds. So the bubble, some froth is coming out. We've talked about that. Now notice this particular date, and I'm also then looking at the U.S. Sorry. I can get it. My hair's not in my way. I'm looking at the yen, as it has also fallen with bonds, right? And this has turned the dollar yen carry trade has absolutely popped on the same date, January 27th, and continued higher. This is the date that FOMC statement came out where they changed their language and allowed for hotter inflation. That was it. And this has been moving higher, and bonds have been moving lower, obviously, as yields have risen from that statement back on January 27th. They changed the language, right? They said, we're going to let it run a little hotter. Okay, So they changed the statement. We have this move. Now we have FOMC again with a statement coming out tomorrow, and Powell presents half an hour later. Are they going to really, have they accomplished their goals here? Yields just fired higher, and I don't want to show these messy charts because it's going to be confusing. But the point is, will they have, in just this short amount of time, have already accomplished their goal? And they're done? Like now they need to whack-a-mole? I don't think so. I think they're going to let this stay range bound and solid, if you will. It was offset by a devalued yen, and now we have a firmer dollar that seems to want to also move higher. There's all kinds of stuff going on over in China as well, but the point is, it looks like the dollar is going to be doing some of their work for them. In other words, it's de facto, tightening when it rises, and yields are firm, and the market hasn't fallen apart. So the market hasn't fallen apart. The dollar is firm and rising. Yields have stayed pretty sticky. Bonds, there's a rotation that happens end of quarter. It's coming in. And I really think that this might also be a time where we have that volatility, the gap fill at 1821. We have bonds having dropped precipitously, and now it looks like yen is ready to bounce. I think we're going to have some equity pullback. Bonds go higher, volatility comes, and we kind of get that two-way market after this week. And it was all from a data point of reading in Mark Chandler's newsletter this morning, where he talked about Japan and China had come in back in January and bought large amount of US Treasuries for the first time in 5 months. They had not done anything. And then all of a sudden in January, they came in and started buying largely. And that particular move, I think, in the yen was currency hedging. Mm-hmm. Is that, am I like, so?
No, I think it's pretty fair.
They added 48 billion in January, the most in 6 months. And that particular moment when that I showed, where the yen started obviously running down the hill with bonds, I think was a currency hedge. I think that they came back in, they bought treasuries, they were hedging with currency, and now it's stabilized. I think now we can start to unwind that. So I'm looking at a potential for the dollar yen coming back down. Market pulls a little bit of volatility up and the market down, and bonds catch a bid into end of month. That's my thesis. We'll see if it proves, if it comes to be, but that doesn't negate the reflation trades. I think they just take a pause, right? Because it's going to have a digestion period now, and small caps are looking like they need to digest. They're too hot. They need to come down a little bit and reset.
It's interesting because, like, I've been pretty busy, so I set my this is total shameless self-promotion here. I set my Leduc trading indicators up for my push notifications because I'm pretty busy. So like I get the XLF one, right? Like the other day.
Yep.
And it was the portfolio hedger, and I was starting to see the underlying volatility coming in banks. And I have not seen banks, weak in any period of time for quite some time. And it was starting to, see a little bit of change in the surface. And then you see some of the Dow components start to change. And I had told everybody, like, I don't know, 2 weeks ago, it was like 31,600 was my level. And then 32,000 was the level. If it went through those, it can keep going. So the Dow's been just kind of rotating inside of itself, right? With those components where it's rising, and that reflation trade and rotation trade. And I saw that for the first time start to show some weakness this past week. And that actually triggered me to look at it. And I was thinking about the dollar, as you're talking about the dollar and you're talking about bonds. It's like, it's almost like this is somewhat mechanical action to an extent, because if I let the dollar kind of, rise a little bit, emerging markets were gaining some advantage globally, as they'd been on a tear, right? Like for quite some time. The dollar goes up, those go down. I mean, it's really straightforward. Most of those markets are direct inverse correlation to the dollar. Dollar goes down, EMs go up. We need to readjust that to an extent. So we let the dollar rise a little bit through currency intervention, whatever you want to call it, kind of what you're alluding to. And then, you've got the bond situation. So as long as they don't have volatility, these things are easier to do. And so, they take their foot off the gas here a little bit, then volatility come back immediately, right? Because, that's just a natural production now. The only caveat I would say to that thesis is you have OPEX this week. And so typically in OPEX weeks, we get your penning action based on market makers. So, maybe it's, you start to see stuff shake a little bit. Yeah, she's agreeing with me there. Keeps trying to throw in 2 cents. So, yeah. I think you gotta consider, especially right now, as dominant as the market action is driven by the options, that you would still see some action for OPEX drive a little bit until next week. So you got the meeting, you got their announcement, you got some pending for the end of the week, and then you can see where it goes through the rest of the month. I do think once we get through this OPEX and we have had the stimulus hit, and we do know what the infrastructure looks like, we're starting to get into where the April and May timeframe and June, where we do have unintended consequences that we just don't quite understand fully yet, right? And things are comfortable right now because we have limited volatility, but you are seeing. I'm very curious to see if the tech trade can make another high. If the tech trade can make another high, this can continue. If the tech trade cannot make another high, just from a market structure standpoint, which right now it looks like the ARC stuff can be very difficult to do. Right. Q's not so much, right? Q's not so much. I don't know. I mean, they got it. I give them 50-50. So it can get a little higher, but I am in that time frame, and I'm very comfortable saying this, that we're not on indefinite time with all this stuff. They've done some really, really staggering things, and I think they've gotten away with it because of the deflation that comes along with technology, and we've been dealing with that for quite some time. And then we also have been dealing with kind of a massive deflation with so many people at home, that this stuff can change and will change as everybody goes back to somewhat of a normalization to an extent. And people are 100% doing that right now, right? Vaccinations are pushing through and so forth. So we're in that period where, okay, what have we done? And how does it shake out? Which then that's April, May, June. And, it's when you're, we've got NFTs, on an NFT of an NFT's NFT, right? Like the non-fungible token. I mean, so we've got some speculative things going on now that are just going to be laughed at years from now. And there's speculative, and I've seen things in Florida, speculative in real estate I haven't seen since 2005 and 2006, and people bidding up properties that are literally should be condemned and things like, I mean, just crazy stuff. That is, the Fed is reactionary. They're not proactive. So no one will they're never proactive. They're not going to come out and do anything. I think it's the April, May, June timeframe. I'm comfortable saying that at this point, that I think we're at some point in time where the consequences of these decisions then start to manifest into whatever it would shake out. So.
Well, okay, so you're thinking this is
if this pullback, to speak specifically to your statement, if this is a pullback, I think it's a pullback that's purchased unless something really changes in the vol structure. So if the vol bounces, it would be a bounce that's going to be bought, right? As we get into April and we get into May, that reaction on a vol bounce, is that going to make a new low? Does that shake? Is there any type of options repositioning that takes place in the market structure? Do we see anything like that, and that reflects itself in the volatility in April, right? Late March could be the beginning of that, and you get into April. I just think that the psychologically the levels don't make any difference with ETFs, with the one time frame purchasing of passive ETFs. The money will keep pouring in. Business activity picks up, people come back in. So, I think running hot and the reaction to running hot is a thing that we have to figure out. Because you've got $5. If you're right, which you've been right so far, right? You get $5 gas, right? Like,
no, absolutely,
and consequential, and that's the 70s, right? Like that's like where we got a whole nother ball of wax that then has to be fixed, and they don't have any way to fix any of this inflation. That's why they have to let it run. They can't actually taper anything.
Well, the interesting thing that I was trying to pull up while you were talking was the tsunami of selling that is expected in the next few weeks. So SLR, we haven't even kind of talked about, is a concern that many are putting out there. I've been really told, risk manager kind of situation at a bank, that it's not a concern. Big banks are fine, smaller ones not so much. But the SLR is not really going to be a risk event. But just plain old selling, that rebalancing that happens with pension funds, large number, let's see, 60-40 rebalance quarterly will also be a massive number given the increase in assets under management. The rebalancing back to bonds, which now looks like 61-39%. Systematic deleveraging. My cat is really a cameo here. She's stealing the scene. And it's not
Fantastic.
even 5, but it's...
It is daylight savings.
It is in her book.
It's on you. Yep.
Oh my God, that's right. Because we do this at 4 o'clock ET, and in her little brain, this is actually 5. She is overdue for feeding.
Yep.
She's worried she's
Yep.
gonna miss a meal. Okay,
Yep.
so anyway, Goldman, the whole thing, I'm looking at this. This is from the Market Ear, by the way, talking up some very big numbers, 180 billion for sale. Momentum has also changed. There's an article, a tweet storm that I put in chat, which was you would love this. You have to read it. It's on ARK and the illiquidity of the and the systemic risk of ARK as a passive investment, vehicle that is full of convexity. So if you take a look at that, I think you are already well ahead of this argument, because you've been talking about this for months, that it's going to fall on the weight of its own supply.
Yeah, 100%. Yeah,
So,
and the options market sitting on top of that, where she posts every trade. People are going to sit on those trades. She's going to have to change the way she does it. So this is reflexive right now, but that's still a trade that's major trouble. And the flows on that trade look like vomit bags. So there's nothing coming back into it on the underside as far as volume and money flow is concerned.
And if taxes are pushed off, or deadline to July or whatever, June 15th, which they're now trying to position for, but April 15th, there's typically selling, right? Tax harvesting the gains. There's also Biden, through all kinds of channels, talking about increasing, doing a tax hike, biggest one since, I forget, 1933, something big, something hasn't been done for a long time, plus corporate taxes, which will get passed on to the consumer as well. So there are, I think, some reasons to slow down the momentum. But nothing, policy dictates the economy, but nothing has been formulated, let alone passed. But even the rumors of that, I think, will also slow down some of this run. But yeah, so far, I'm just looking for a bond bounce and VIX to tag that 1821 magic level. SLR is also something they're looking for, the extension for the bank reserves. And if that doesn't happen, oh no, there'd be a lot of treasury selling. But like I said, my source says that's not likely. Really, really, really not likely. Hey,
yeah,
Brian.
I agree with that.
And my strongest point about the strength in the dollar has to do with a comment that I grabbed, which I love, from BBG. Treasuries may pass the baton to dollar in inflation battle. And that's what I think we have right now. That rate of change in the yields, the expectations for inflation, the potential for runaway gas and oil higher, and commodities, which we've already seen. That to me is an inflation battle that the Fed will have to somehow, deal with. And I think if history is a guide, they're going to let the dollar strengthen. I really, really do. So I'm
totally agree with you. Yeah.
I'm totally bullish on rising dollar with yields, but not as fast. I think the dollar will now pick up for the increase that's happened with yields. I think that's going to be a stronger move as a vehicle to fight inflation.
Yeah, totally agree. I totally agree.
But I think we're going to get a bounce in bonds, which is really, really, that sounds illogical, but that's what it looks like to me.
Well, you could just say that the bounce in bonds, we're at a point where, just genuine kind of market structure could take hold, right? Like where it's at a level where buyers step in, institutional size, we're at major support levels for a lot of it. I looked at it before we jumped on, just, so the intermediate to long-term stuff this is a level that's like kind of take a stab at it level. Maybe something changes, maybe something sticks. So you talk about just like looking at it from a market structure flow standpoint, it's fairly appetizing risk reward here for at least a transactional trade.
Yep.
If not, maybe something changes, right? And you didn't, because this is not like falling knife stuff. We're kind of dancing around here, where it's like a market maker's opportunity. So I think that, you know, if you look at all this as rotational flows, right, and us putting money in and pulling money out as a group, then this makes sense too. Like this makes sense to take a stab at a trade, which could be, you know, the whole macro theme doesn't change. Nothing truly changes, but it's reflexive, right? Yeah. And it's just institutional flows, especially as you head into a new quarter. You're looking for what's cheap, right? Yeah. And you're looking to dump what's profitable and rotate.
But this is also in support of that. Treasuries, the futures saw record increase in net speculative short positions last week. This was the short sale that I'm referring to that seems way too crowded. Like, talk about, you know, an outlier waiting to revert. At least to me, this is another support for a bounce higher in the bond trade, although I don't see it yet. Like, I see no confirmation of it whatsoever.
Yeah, I think you would until next week, right? Options, right? Got to finish everything pins. Then I'm going to rotate. So I'm going to rotate because it's quad witch, right? Yeah. So this is this is the end of the quarter. You know, you got the options, you got VIX, you got everything, all Friday. You know, between now and Friday.
Speaking of VIX, though, there's a question you can answer, I hope. Do you have a view on AM expiration for VIX tomorrow? There are a lot of puts. Wonder if they finish in the money.
Could be. Like, there was a pretty, you know, gross move today. I mean, the last couple of days, we got all of our stuff like internally, like the you know, alerts that we built for volatility, like called the, you know, suck out, free falling, things like that. We got those earlier this week, and it's been pretty true to form. So I think that could, you know, that could very well happen tomorrow. Okay. Right. I don't. If you look at the term structure, you don't see anything. And that term structure that gives you any, you know, there's zero fear. And I'm not seeing a lot of index puts in that. And I will say that the call structure has changed for the single stocks. That has tapered off.
How so? Okay.
So it's not nearly as eye-watering as it was. So just single stock call buying has not gotten back to what I would call, like, you know, parity. Like, it's not near one, right? Anything like that. But we're regularly up in the 0.6, 0.7, 0.8 put call ratios now. So things are leveling off. So I think you're seeing kind of like what's what I would call the tail end of the trades here, overall, right? Like, you know, yeah, VIX is going to die. It's going to go to zero, right? Like, I don't, you know, we're all talking about like new paradigm stuff at this point. So I would be on the lookout for your reaction after OPEX, right? Where you do get a bounce in VIX for any specific reason to what that retrace looks like. So you do get a bounce, you do get these inflection points you're looking at. What was a retrace of that look like? And do we begin to shift, right? It's not the first move. One move doesn't stick. It's the second move that sticks if there is a change, which would be interesting. That would be in April. And that would kind of jive with the kind of the bigger picture. So I think that stuff ends up in the money tomorrow, unless something dramatically changes overnight. I mean, and if something changes overnight, then you're talking about, like, you know, one-off deal. You see this positioning change. You know, you do see this underneath, right? And you've talked about this at length many times. You begin to see some positional change. Your portfolio hedger is built on that positional change, and we're not seeing any of that right now. So you know, these plots, and, you know, yeah, go ahead and say what you're going to say with this. I'll leave that be.
No. I was just putting this in the background while you're talking, because we don't. I mean, you just answered the question about VIX for tomorrow expiration, but I also grabbed this. The market has no patience for the Fed being patient. I don't know if the market seems to be doing fine digesting higher yields, but if Chair Jerome Powell on Wednesday pushes back on the current pricing, the markets will likely think he is in denial and therefore accelerate the timing and the magnitude of the Fed's first rate increase. That's the risk that right now, lack of response. You and I are in agreement, they're not going to change anything. They're not going to do, the SLR probably gets extended, although that is a risk if they don't. Yield curve control, no, it's way too early, and it would require, it involve the unintended consequences that you talked about last time in sucking liquidity out of the market. So that's not a good solution for right now. And they haven't gotten obviously high enough to break the market, right? ARK is still standing. So anyway, that's the possibility that by not saying anything, they say something. The only other thing I was,
and I don't, yeah, I'm with you 100%. Like I hear what you're saying, right? But it's like, there's just not, that's not the reaction. Like it's a bluff, right? It's like, the real sizable players are like, okay, you're not gonna do anything, right? Like
players already know.
You're not gonna do anything. Like you may even say something, and you ain't gonna do anything.
This is a powerful survey, though. I really, again, I've been on this for like 7 months now. This September 4th was my growth value rotation thesis. I really thought it was the top of the mountain and it was going to start going down, and it didn't actually pick up speed until January. Solidly in play November. This I understand. The Pfizer vaccine, the blue wave, but it really accelerated in January. And now what do you have? What do you consider the biggest tail risk? Higher than expected inflation. So this then a tantrum in the bond market. But what I was actually wanting to show was technically, because you and I are still technical analysts, we like to use the macro as a backdrop and sentiment like this survey. But right now, and this was done on the 12th, but still, we're right here. So this yield curve, and I'm talking about from the very shortest to the longest duration, is just approaching a resistance level. And for me, this is where it gets interesting. And I've also done this on the 2 and 10. But the point is, once it gets above, that's when volatility starts to come in strongly. So I'm intrigued to see where we're going to go from here. But you know how we've had a V-shaped recovery in stocks? Well, we've had the same thing here in a steepener of the yield curve. And once it gets above, that's where things start to kind of get a little eventful. But for the most part, we're doing pretty well in regards to digesting these yields. And we've had currency, I think, hedged as a result. And now it looks like they want to bring up some, let the dollar rise a little bit. I can't show this so well, so I won't, but yeah, these are some charts. Yeah, never mind. So in regards to, I was going to show it, but it doesn't pop out very nicely. It was the dollar with CPI, and we're still very short, speculative net short the dollar. So this is another thing where I think if this starts to cover and move higher, which firmly looks in play to me, then I think it's going to pick up speed because of short covering.
It's interesting. Like I was thinking,
I get my hair right.
I was having the short sell conversation this weekend because I like to check in every once in a while, see how that's going. Like if guys have any appetite. And at the same time, we were talking about like UBI, right? MMT. Because if you let inflation run hot and you get $5 gas and that affects into the rest of the commodities affect ag, and ag affects groceries and all this kind of stuff. You're gonna have to continue to provide stimulus. And so I said throughout to a couple different people, a stimulus done, as I said, are we gonna see more stimulus? Is that the reaction from policymakers that kind of Fed and Treasury in conjunction? Because those, the Fedjury, which I coined, I take the credit for that last year, right? Cool. The Fedjury, when they married, right? So
okay.
Yeah, so it's Fedjury. So now officially married because you got Yellen running.
Very much so.
So when you look at that as kind of a collaborative effort, then are they going to throw, would they prefer inflation and just, talk it this side of it? We don't see it. let it happen. And then every time it gets like uncomfortable to an extent, we're going to drop another $1,500. Done would drop another $1,000. Like, is that something that's very feasible? I think it is. Like, I think if you don't count that, that would be a reaction that they'll do until they can't do it anymore, until something really, really, really breaks. From what we've seen, then I just throw that out there. It's like something that was in conversation this week with some smart people, because it's a path of least resistance until it formally breaks. And if you look at, like, maybe I can neutralize emerging markets through the dollar, right? And some of the inner workings that can be played along with that to try and stifle kind of, the exportation of that inflation. So I think, I'm very curious to see what transpires when you got $5 gas, right? $6 gas, because it's coming. And then what, right? And, because the Fed has to raise rates, that would change, that's going to be a totally different deal than them. They're reactionary, 100% reactionary. So I'm of the mind that, I've watched this for a year now with them, and everything that they've done as a unit since they both went fiscal and they went monetary at the same time, right? Since that has happened, you got to expect what is the path of least resistance. And that is what they're going to do, and kind of let that go from there. Now, it doesn't mean it'll last forever. It just means that it will be until something forces them to do something that then forces those people we talked about at the table to actually, somebody's got to go down, right? It's either the pensions and corporates, or it's, the next generation, right? Like, and we'll see. I still don't think we're there yet, but we're going to be approaching it soon, because you can't put, what are we at? 15 trillion right now, something like that, into the system and not have some significant inflation. Right.
So this is why the survey ranks so hot, right? So this is another thing that is supportive of this inflation move. Hold on, let me bring this up. I've shown this since December, but this is basically that yield curve I was just talking about, the 2 and 10. So you can see where we kind of intonated, okay, we're getting above and we're starting to steepen. Well, guess where we are now? Right here, this yellow arrow. And guess where we were pre-COVID? Here. I still think that's where we're going. So even if we digest this big move, right, from, and this is, by the way, the 2-year bond, but still, this is, the yield curve has traveled all the way up to almost 1.6 today. So this is your commodity, your cyclical, your energy, your value, your, reopening trade right here in one chart. And now here we are. And it sounds like the Fed isn't going to do anything tomorrow. It sounds like they were okay with higher inflation because they wrote it into the script on the 27th. And it definitely sounds like they were okay when they came out and were talking 2 weeks ago. So as this moves higher, we're going to get that higher gas, right? Mm-hmm. We're going to have the inflation. And it's interesting because you were just talking about, kind of the passive stuff. And I saw this today, which was Bridgewater's Prince. I know he did it a few days ago, but warns on risky assets after a bond decline, and talks about this, the portfolio construction, the weighting, the passive investing. Passive investing is very dangerous right now. And Professor Plum, who's on Real Vision all the time, Michael Green, he's talking about and reminding they have been massive net sellers despite assets under management rising. And why? Due to valuation increases. So, but still, this comment and his facts that are supporting that rotation, if you will, the boomers are selling, the millennials are buying, but it's still net selling. The reason why it's going, but it's obviously rising due to valuation increases, right? The market, but that's deceiving. It's very deceiving. So I kind of put that together, what he said on top of what Prince said. It still feels like there is an air pocket of risk anytime with ARK, their investment scheme. I'm not saying, I don't want to discredit,
It's their program. Yeah, it's just the way they operate. Right?
Exactly.
Yeah.
So whether it's the weighting or their their balance, if you will, of adding all this heavy concentration and a whole bunch of illiquid plays at the same time, that just seems to be a little problematic for stability. That's all. I'm just with a rising dollar and rising yields and rising oil.
Yeah, I also think if we're talking bonds, maybe we talk a little corporate. LQD, right? BKLN, HYG, J&K.
Mm-hmm.
Those play such a part of portfolio construction from the FA world, and those were really, MUB, like the muni stuff, a lot of muni stuff. These things were like vaporized last year, and
they
the
still
Fed
look like weak sauce to me. They look terrible on a weekly. They look terrible.
Like these things are being propped. I don't know if somebody had the last statistic of the Fed's ownership of these, that would be fantastic to see.
Yeah, I don't have it
offhand, but
yeah, I know like Fed has like 60% of the TIPS market.
Yeah, and I know like J&K and HYG, like I want to say they're the largest holders, right? This is a big piece to me. Like LQD's weakness is interesting because LQD's in that basket, but LQD's down 7% last few weeks. And so, these corporates and the pensions and that bond structure seems to be more concerning to the Fed than the government bond structure, right? They don't care. And because, they just they reshape that kind of play using your dollar, right? The dollar piece. So when I look at these, I think it's important to continue to monitor what happens with the corporates, because that's the real, to me, would show any type of sign of weakness. I always look at the junk of the junk, especially BKLN, then those types of products that are wrapping up that really kind of real high yield stuff that's very, very dicey. Highly illiquid stuff. That paper is like really important to me, in the bond conversation too. And so I look at the Fed to be more reactive to those things than even for what it's worth, than to the government paper.
So I have just a comment on that, and I don't even have it fully fleshed out in my head, but I had made a comment about higher oil, and Robert, who I had on my interviewed last Thursday.
Yeah, a lot of that is in those. Yeah.
But there isn't this speculative net long positioning in oil. There should be more sign of it. And I had a comment from a colleague who said banks lost $100 billion on their investments in the oil and gas patch in the past decade. 2 years, remember, 2014 through 2016, $66 billion worth of bankruptcy. Mm-hmm. So they're not really in a hurry to run back in, especially with this, ESG conversion and all that stuff. But the point is, they are gun shy. I think that's one of the reasons why there hasn't been this, intense, for Robert anyway, the signs of strength in positioning in oil after a decade of massive drawdowns. So that's my rationale for it. And then when you say, the corporate junk bonds and high yield, ETFs that we definitely follow and are, you and I can both see, they are weak. They are weak. So that's also a lot of those zombies that have been propped up by the Fed.
Yeah, the interesting thing is this stuff is oil
and gas zombies specifically.
Yeah, but they're slowly they're propping them till they get their feet, like AMLP, Master Limited Partnership for piping and so forth.
Yep.
That stuff's up 175% from the lows, back almost to the gap fill. It's almost like we're rotating everything to get everything back to gap fill, and then maybe they take the training wheels back off, or they don't. But I don't. The underlying of all this stuff, and not to go like super macro, is it's super K recovery, right? Like stuff got a lot better. Anything that was supportive and has run away, but then the underside of everything else has been just depleted, right? Like and so when you look at like how that shakes out with inflation, and then you look at what they have to do to prop up bonds in the corporate environment, and then how those bonds are directly correlated to the pensions and to the not the pensions necessarily, like, but or not so pensions, but then also like RIA stuff, like IRAs and so forth. Like these are major vehicles that are utilized and all that. I wonder, with all the zombies and all that, like it just seems like that they really care about that a lot. And no matter what they have to do, they will keep that stuff alive because of the not, even if there's no one there. It's like one of those CCP companies that was traded on the exchange years ago, before they started cleaning that stuff out, which was what SPACs were really used for like 7-8 years ago, that Quote the Raven used to do all the research for, where the companies were reverse mergering because they existed in China. Nothing actually existed. They were just buying paper and creating shell companies. Effectively, a lot of this stuff has ended up being the same thing. So we're doing the same thing and then supporting it simply because it supports, a pension program or something else. So when
how do NFTs?
Yeah. So like, it's all, there's a lot of hollow nature to the infrastructure in general, which goes to your comment about ARC, or any one of these type of vehicles that is heavy, that can trigger some market instability. Those may become important, as well as these corporate bonds, like to keep your eye on in the next couple of months, because once these things get to a level, like the airlines have, they help support those back to a level state in their perspective. These oil and gas companies have been supported back to a level state in their perspective of market structure. We've sucked out volatility best they can do. So that's my 2 cents on something I'm looking for, is what happens to the corporate bond market and with it relates to inflation. And then, that takes us all the way back to that table where somebody's got to pay the piper. Is it the pensions and the corporates, or is it the future generations, right, that are just gonna deal with it? And I directly think that's kind of one of the great equation pieces for the market here, right? That it could be closer than not, looking at that rate, one you showed a second ago with the breakout, right? Where you've seen it, the steepener, where it's very close. I mean, it could be a month or so, but no one knows at this point, right? Like a specific moment, but we've talked about for everybody that's like just jumped on, and I'll run with this for a second. With the option market the way it is, and it's overwhelming the securities market, you can have a situation where you get something triggered, right? Institutional flip, right? Where they'll flip, and that gamma flips and the short sellers get nuked. So all you have to turn this cycle is short sellers nuked, which then triggers institutions, which then triggers the gamma, right? And it flips. And, since so many people are sitting on that short vol trade, to the point of the question earlier, will those puts end up in the money tomorrow? Well, that's the expectation everybody has. So any of these like kind of outlier, like heavyweight market structure players like ARC, who's the size of Vanguard, or any of these kind of runaway stocks, the Momo stocks, any of these can trigger some break apart. But the key for me is watching the bonds, the corporate bonds, right? And seeing how that shakes out as it relates to the pensions, and what can they control it as it relates to inflation. So
in a nutshell. And someone asked in chat, what is this SLR business? And there's an excellent article on SLR, to extend or not to extend, but it's written to, first of all, give an overview of what this even is. And I'm not going to go over it in detail. I'm just going to reference it because it's such a good one. And it's definitely impactful to the plumbing. Mm-hmm. So this is an article if you want to understand a little bit more about the bank leverage exposure, why it's important. There was a recent run on primary bank, on dealers, if you will. And this will kind of go through and talk about this. Really, in some cases, a lot of detail, but I think the bigger issue is their motivation. They are incentivized not to allow for negative rates. So that's very supportive of risk assets. In other words, there's lots of money in the system. They don't want to go negative. So this being extended is very, very likely. But it does give non-renewal implications, how do banks, deal with it. Again, large banks are a lot better off than smaller banks. But as it relates to the plumbing, definitely not a retail subject that I could ever teach about, because it has to do with, primary dealers and behind shadow banking.
If you start digging into that, anybody that starts reading into that, you could really go down tier one capital, right? And how that shakes out and what is considered tier one capital, et cetera, because that directly plays into the dollar conversation, the Bitcoin conversation, the gold conversation,
yes.
right?
All based on the dollar.
Right. And so, this is like actually a fantastic thing to explore if you want to fully understand like kind of how banks are structured and how some of that stuff you hear.
They have to do this. It's not, they don't want to.
Yeah, it's some of the stuff that you'll hear people argue about certain things about gold or about Bitcoin is just total and utter nonsense when you really understand how banks are capitalized and how this is structured, right? Because we do live in a debt-based structure where, tier one capital allows for that 1-to-10 ratio to go, which is why derivatives, come into the fold and why we continue to expand basically way more than we actually have on any type of underlying. So that's for what it's worth on that. I think that's a great article and a great topic, and definitely dig into what tier one capital is.
But it definitely feels like they're going to stay or sway away from from yield curve control talk or calendar guidance maybe. But the SLR was a really big concern. Zero Hedge highlighted it and a few others. And then I was told, don't worry about it. But I'm looking for a narrative to fit my next tag of my stock bond volatility ratio, which has tagged again. So every time it tags, there's a volatility trigger. And it could be small, it could be large, but there's always a volatility trigger. So I'm really fascinated what it's going to be. And right now, I'm just want to get through this week.
Yeah, OPEX. Yeah. So the question is, if Powell says informs nothing new, continuing same monthly level of QE, how would the market take that? Lots of tweets about more verb. What do institutions expect? So we kind of touched on that earlier, but most of the institutions don't believe that they're going to do anything ever. They're kind of cornered, right? And so, even if he says something, I wouldn't, you got to kind of think through it from a game theory perspective. Is he going to go up there and he's going to say something that's going to trigger stuff like SLR or force himself into YCC? No. Historically, every one of the, like, if you back tested all of their stuff, they never are like proactive, not since Volcker, right? And raising rates to curb inflation. Ever since then, it has always been, we'll just let it go until it breaks. And then we will, deal with the volatility at that time, neutralize the volatility, and get liquidity flowing again. That is the game plan. That's the MO. There's no other plan.
Intervention. Yes, not prevention.
Intervention, not prevention, right? And so expecting something to take place like that would be, kind of bad game theory, right? So the institutions will side with.
And yet I have my volatility trigger ready to go again.
Yeah, so I think
there's got to be a narrative. I just haven't found it exactly.
Doing nothing, right, is what he would do, because he doesn't have to do anything right here. That doesn't mean you won't get bond buy. So you get a bond buying tomorrow, right? Because it's just an institutional trade at this point. It's just good risk reward. You could have like a dollar kind of action, because we're inside micro moves now. Right, we're inside some tradable moves, which would cause some reflexivity just in sheer positioning, and then options roll off. You also have
gold.
Well, look at the two. You had the futures. I said it last week. Futures rolled. Everybody's out of the March contract. Everybody's into the June contract now. So now you can have some action in the futures contracts. Futures drive the derivative vehicles. So if you like all Direxion vehicles, all those TQQQ, all that stuff that you trade, that hot sauce stuff. That stuff's all driven by those futures contracts. That stuff rolls, then it loosens up again. So now you get some action, right? So this options comes off. So it could just simply be, reflexivity to, repositioning. That then, where does that settle, right? I would like to see it happen and then see how it settles and see what the term structure starts to look like in VIX. That's what I would tell you. What I would say about watching Powell is like paint dry. I actually stopped watching it because I always fell asleep now at the theme music that comes on at the beginning. They put on like the chill lounge music, feel like I'm in Miami Club. So like I fall asleep by the time that it goes.
I just watch gold.
It goes down.
Gold always seems to know what's coming when it comes to Fed Day.
Yeah. The most animated I've seen Powell in the last 2 years was the GameStop questions. He did not. He was really pissed off that he was having to answer questions about GameStop. So, that was entertaining, but I would expect nothing tomorrow.
All right. Well, we're going to leave it there, and then we'll pick up next Tuesday and find out if we need to find a new narrative, because we will have a new quote unquote month, meaning quad witching is over.
Yep.
Volatility will have, let's say, a reason to rise according to my stock bond volatility ratio, but we need a narrative. If you've got one, send it to me. Right now, I can't just say valuations. It's just not going to be strong enough. And okay, I haven't looked at the market since 2:30, so we'll go in and take a look. But I thank you so much. Real quick, I wanted to just remind you where this goes. Little housekeeping after the fact, and it will be here, Leduc Trading Channel, and it'll be right underneath Macro to Micro Power Hour. So this is my last week interview with Bob McMahon, the oil trader, who said that was very easy from November, until $65. Now it's going to be the chop, either before the drop or we're going to shoot higher. But right now, this is a tough oil trade, and this is Big Tech, home of, and you gotta go, because I know you got meetings, and this is very exciting. You got some want to give an announcement though, at least what's happening in
we got a new you get a whole new site, you get a whole new launch. The web app is in process right now. You're starting to see some features of that. You've got a whole new mobile app getting launched, and then you've got Samantha's indicators, which are in beta, which will be final launched in the end of the month, March. So look out for major options products coming to the market here from us.
Can't wait.
That are powered, that are I would call supercharged. I mean, we've talked about option stuff. You and I have talked about it since we started doing the show. It's how we met.
Yep.
Talking about these things, and our belief is that options is such an important part of the market that this goes past some of the stuff that you typically have seen. We're taking it further
Can't wait.
Across the board. So we're hoping to
knowledge is power.
Yep. We're rolling that out to everybody, first week of April. So
awesome.
Look for all that. And that's it. That's all I got.
Thank you so much for attending, and I'll post this on my YouTube channel. Good luck with your meetings, Jonathan, and see you back here next Tuesday.
Thank you, everybody. Appreciate it.
Cheers.
Good night.
Bye.